Thank you, Kevin, and welcome everybody to Marine Money Athens. It's great to be here. My name is Dave Herman. I'm at SSY working on S&P and projects transactions. Maybe before we get started, I'd ask my esteemed panel to give a quick introduction on themselves. Constantine, would you start?
Sure. Constantine Nanopoulos from Starbulk. I'm the deputy CFO there and co-CFO on the private side. We manage 142 dry bulk vessels on a fully delivered basis and are the largest US-listed dry bulk player.
Good morning, everyone. Evangelos Chatzis, I'm the CFO of Danaos Corp.
Morning. Yes. Good morning. Many thanks for the invite to Marine Money and congrats on the new fresh venue. I'm the CFO, Alexis Stephanou, CFO of Goldenport Group, diversified across dry bulk tankers, container ships, gas, and more recently in the offshore sector.
Good morning. My name is Hugh Eden. I'm a managing director at Jefferies in our New York office.
All right, thanks, guys. When I saw the topic for our panel, it struck me that we were going to make an effort to answer the age-old question of does size matter in shipping. So with that, maybe Constantine, you indicated Starbulk runs 142 ships. Could you give us some perspectives? First maybe on how you got to that size and what benefits and maybe even detriments does a fleet of that size have for you?
Yeah. So for us, when we look at transactions, we want to do something that can increase our market capitalization, trading liquidity, and be accretive on NAV per share and earnings per share. And since 2018, we've looked at various transactions. We've acquired more than 100 vessels, doing 9 M&A deals. And that has been kind of what we've been looking for in order to expand the platform and make it more attractive to institutional investors. Now, bigger can be better if you deliver on the target of consolidation. So I would say 2-3 things. One is synergies, right? You need to be able to deliver on the bottom line and make the economies of scale, show them on your bottom line and make sense. So, for example, the recent transaction we did with Eagle Bulk, we've announced that the latest public information is that in a little bit over a year, we have more than 50 million of synergies. That's what we had told the market, and we delivered on that. And that's kind of bottom line effect. Now, number 2, market capitalization, trading liquidity. The more you grow, the more you increase your liquidity, the more attractive you become to investors, in our view, who can easily come in and out when they want to invest in dry. And number 3 is your capital allocation should also mirror kind of where you are in the market. So when you have opportunities to distribute that capital and give dividends or buybacks, then that makes your equity more attractive. And then that's a self-reinforcing mechanism where the equity is more attractive and you can do more deals.
Thanks for that, and I think I'm going to want to come back to some of the synergies and operating metrics in a little bit, but let's get some other folks involved here. Evangelos, you and I go back quite a bit, as I was involved in your IPO over 20 years ago.
20 years.
And at the time, I remember Danaos had a fleet of a little over 20, maybe 25 ships. Today, including new builds, the company's over 100. Could you give us some perspectives on what it took to achieve that growth? How you accomplished that? Was it all new buildings, or was there a decent number of secondhand S&P deals in there, and kind of how you got to where you are today?
Yeah, thanks, Dave. Yes, the majority of our organic growth came from placing orders for new builds. When we went public, we had a pretty big order book in line with what the industry norm was at that time. So we made a big leap from 2005, 2006, when we met, through the next decade as we got delivery of all the ships we had ordered. We also bought a number of ships in the second-hand market in the ensuing decade. That was new builds were placing orders were out of the question because they were costing 5 or 6 or 7 times more than what their equivalent second-hand counterparts were. So yeah, it's a mix in terms of how we grew the fleet. And just to follow up on Constantine's very fulsome sort of analysis, yes, size matters. All other things equal, with size you get better access to capital. Better capital in quality terms, better priced. The question is, how do you deploy this capital? And size for the sake of growing is not a good recipe. You have to be very disciplined, especially in times like today, where a company like ours has many tools in our toolbox to source competitively priced capital. We have to be really careful and disciplined on how you deploy it. Because growing for the sake of growing doesn't say much. We're in business to make money.
Thank you, and we're certainly, particularly given the financial nature of our panelists today, we're going to come back to the cost of capital and the benefits of size as it relates to both the cost and access to capital. Alexis, I want to get you involved here. Goldenport's got a pretty diverse fleet. Maybe give us some background on how that came together. I know you've got some interesting JV partners and kind of how you think about deploying capital across different shipping sectors.
Many thanks, Dave. Goldenport, the group originated from the dry bulk and container ship side, diversified into product tankers in partnership with Glencore in about 15 years ago from now. We then expanded further in the tanker space. In 2016, we took what was a publicly listed arm private, and the next diversification into VLGCs came in 2022. And offshore was a further investment that we made last year. I think being active in several sectors gives the opportunity to take advantage of the cyclicality, which at the current point in time seems to be moving, the subsectors seem to be moving along together to a large extent. But the more normal situation is that there are some sectors performing well, there are others that are not performing as well. So you can redeploy capital from one sector into the other. That's basically the strategy that we have been pursuing in assessing what are the return and the risk prospects in the different subsegments.
And could you give us some insight into how you think about not just approaching, but also reinvesting in sectors alongside your JV partners? I mean, where does the impetus, where do the transactions, how do you all think about growth within a specific subsector?
Well, look, having joint venture partners in some of our vessels, in particular cargo interests, has helped us de-risk some of the investments that we have made, as the partners typically have a specific requirement in terms of vessel, in terms of specifications. So you actually contract a vessel for a specific purpose rather than on spec, on speculation. And then what we also find very rewarding is that in working together with a partner like that, you have concrete discussions about the market, about the outlook, about what is going on. So you can adjust and refine the strategy as we go along.
Excellent. All right, Hugh, sitting at certainly a leading shipping investment bank in Jefferies, could you give us some perspectives on how Maritime is viewed in both the U.S. and the broader capital markets today, and in particular with commentary on small versus large companies, and just generally where the market's at.
Sure. I would say it's certainly more topical these days, just based upon the headlines. Historically, you see ebbs and flows, entries and exits from institutional investors, private equity investors, et cetera, that follow opportunity. I would say in recent years, and this was on a previous panel, there's been a wider commitment to developing new tools, new pools of capital to find new ways to play the cycles. So instead of just looking for asset opportunities, there's new financing, more structure, more capital to deploy. From a public market perspective, as Jerry mentioned, there are fewer public companies. We would expect this to continue into the future, near future. But new companies are under development today, right? And so capital markets, I think there's a long relationship with shipping that, through cycles, there have been lessons learned. For the large part, most of the public investors are hedge funds, right? So they're looking to express a view on trade, geopolitics, a sort of value opportunity, et cetera. But that's the longer game, is building an institutional relationship with the market, demonstrating stability, a vision. And as we see in consolidation, one of the trends has been to build larger companies, build a bigger relationship with the markets, and also, potentially build your platform into other segments that can reduce that volatility.
As an observer of the capital markets, it strikes me that back in the early 2000s, there were a lot of smaller companies, many of whom were able to go public. And over the years, we've talked about consolidation and the benefits of size, but there's also been, over the last couple of years, there have been a handful of smaller companies that have been able to issue, shares or IPOs in the markets. Could you, maybe just give some perspectives on, kind of the way the investors think about, size as it relates to some of those issues?
Yeah, I mean, I think that speaks to also the wider toolkit that the companies have as well. I think, every potential client or company has their own specific objectives, some of which are to raise capital in scale, build a significant shareholder registry of, XYZ targets. Others are seeking an expedient or otherwise, unknown path to getting public, and then kind of using that opportunity set to develop further. We've seen a proliferation in those strategies, which is interesting in terms of, the wider investor universe expanding. However, I would say, traditionally the IPOs, the larger size equity offerings, those have been, fewer and farther between in recent years.
Constantine, Starbulk has been one of the, certainly one of the most active consolidators in the shipping space, not just dry bulk. What's your approach to growth? How do you look at target companies? And then you talked about, you suggested there were $50 million of synergies from the Eagle transaction. What sort of metrics are you focused on to help drive the value creation in those acquisitions?
Yeah, so I mean, shipping is a very dynamic industry, so that changes overall, right? We always remain kind of very analytical on when looking at opportunities. We want to see everything based on fundamentals, supply-demand balance, where asset values are in the cycle, where freight rates are, and then we try to evaluate what segment or size might have the best risk-reward, risk-adjusted returns. And so our focus kind of has traditionally been to do accretive deals on an NAV per share and the EPS of shareholders. Now, what has changed over the years is that the opportunities are different. So, for example, back in 2018, when we started doing M&A, the opportunity there was that you had fleets owned by ship owners in JVs with private equity. Private equity wanted liquidity. The S&P market was not liquid at the time, so they could not go out and sell 15 vessels, for example. So there was a trade to be made, get liquidity in a public platform. And for us, our job was to be there, to be transparent, to do a good job on the operational front, to be an attractive equity for someone to partner with us. And then we saw that in most cases, the private equity took the equity, sold out, but the ship owner maintained their upside and participated as the market increased and strengthened. Now you have a completely different picture, right? Now you have a much stronger, owners are very liquid, the S&P market is very liquid, so someone who wants to exit can very easily go and get a cash offer or wants cash. So on a relative basis, if the equity doesn't trade that well, it will be much more difficult to do a deal. And in any case, as all my co-panelists know, you look at 10, 15 things and you get only one thing over the finish line. So it takes a lot of effort and a lot of analysis and to be there. But scale helps in getting kind of the deal flow in.
Hugh, could you add some color on Wall Street's reaction to these, what I call ships for shares type deals, and how, particularly with a company like Starbulk, increasing the market cap and increasing the free float, how that's received, and what sort of benefits are there to the institutional investment community?
Yeah, I think the institutional investors are with a large, sophisticated operation like Starbulk. They're paying attention to how accretive these deals are, the increased depth in the shares, depending upon how locked up or long term the holders may be, only helps the case for institutional interest. Right, one of the primary complaints across our industry is depth of shares. Right, so oftentimes investors who want to express a view in size have difficulty entering and exiting a trade. So as Starbulk has slowly and steadily built the business through attractive share deals and other M&A, that's only helped the cause in terms of depth of liquidity, scalable, right? That's a business that's highly scalable, and unit economics improve, et cetera. So all of those are positive outcomes.
And does that, overall, as a community, I know we often feel like we struggle to attract the interest of institutional investors. I mean, do these sorts of transactions help bolster the shipping industry in the eyes of the investors, or are we still seen as sort of small and highly volatile?
Yeah, from a public perspective, we have the same difficulties, which is usually it's a thematic investor, and they're looking for the most liquid and direct way to express their view. Privately, I don't think the industry has any trouble attracting capital. I think there's been a proliferation of alternative sourcing, bank that continues to be very attractive, and private equity. While entering and exit, there's been sort of a new iteration today of new sources, new pockets of capital, and new themes emerging institutionally with these funds. So I think it just depends on what side of the ledger you're looking.
Well, look, clearly size plays a role in our industry, not the least of which is in the form of accessing capital. And for those of you who don't know, Evangelos and the team at Danaos just last week executed a $500 million high-yield bond in the U.S. market. In a minute, I'm going to ask him to give a little bit of color on that, but it was a $500 million unsecured transaction that remarkably was priced
7%.
Well, I was going to comment on the fact that it was priced only hours before President Xi announced his counter tariffs against the United States. So in an act of
Perfect
unbelievable timing, hats off to the folks at Danaos and their underwriters. So Evangelos, maybe give us some background on that and some insight as to how it played out.
Yeah, thank you, Dave. Indeed, we concluded a bond offering. We closed last Thursday, hours ahead of the Chinese announcement that kept us up all weekend trying to figure out what is and what is not. It was an offering that was very well received by the market. Danaos has a very solid balance sheet. In fact, we had a number of meetings with institutionals, and to be honest with you, I had a pretty easy story to tell. Because our balance sheet, our numbers, our credit rating, which is at the ceiling of where public or of where shipping companies are now rated BB+, these all things speak for themselves. And also, we did this offering on the back of the first offering we did back in 2021, the inaugural bond that we did, which was for $300 million. And since then, we got the chance to build credibility in the market. Track record means a lot, both with investors, credit analysts, rating agencies. So, and most importantly, we executed on what we promised. So you need to have a clear vision and you need to deliver. And through that process, you become a mature issuer as time goes by, and you get better access to capital. And it is important because, you know, you can, in that manner, you can sort of de-risk your capital structure, diversify your sources of funding. Granted, secured bank debt from the traditional providers will always be the most competitive component in the capital structure, but it can be volatile. We've seen post-financial crisis banks running for the exit. You now have recent regulatory challenges with Basel IV, where you may see banks again reducing portfolios. So you cannot rely on one source. So you have to do a bit of everything. And same holds for, and I heard in the previous panel, Japan offers very competitively priced capital. So you need to place your chips appropriately in order to secure a competitive capital structure.
You talked a little bit about alternative sources of funding, you know, banks in particular. Maybe just give the panel, or give the audience, excuse me, some insight as to, you know, why you chose a high yield deal and in the U.S. as opposed to, you know, maybe a Norwegian bond or a European or a Greek bank deal.
The US/international bond market is way deeper than any other market, right? So when it comes to refinancing a bond, for example, you know, you will always have a deal at a price. This is not, it has not proven to be the case in some instances, for example, in the Norwegian market. And this is why when we first considered issuing a bond 5 years ago, we made the brave decision to pursue a credit rating because you cannot have access to the international bond market if you're not rated. And, you know, being a shipping company and with what we've seen through shipping cycles, it is a decision that people hesitate to make. We went through with it because we have a business model that is, you know, that can fit well the scrutiny of a rating agency. So that's how it became possible for us to issue. And, you know, issuing a bond, we issued 500 million, 7-year money, bullet, no maintenance covenants. It's a very flexible form of capital, but you should not just see it on a standalone basis. We fit this in our capital structure on how we want the overall profile of our debt to look like so that we can sort of have capital to allocate to create returns, and that because that's the objective.
Alexis, you commented that back in 2016, Goldenport and the shareholders took the company private. Could you give the audience some perspective on what was the thought process behind that, and, you know, almost 10 years later now, you kind of how you think about running the company as a private company instead of a public company? What are the benefits to you, whether it's informing JV partners and accessing capital in entering new markets? How do you think about, you know, that decision 10 years later?
Well, look, the take private transaction was concluded at I think at least a decade low, or I would say even a more long-term low in the dry bulk markets at the time. So it was a counter-cyclical move for us. I think the public market investors, especially in London, where the company was listed at the time, they were reluctant to inject more capital in the company. So we just decided to take it private and move forward on our own. And instead, what we have been pursuing is, as I mentioned to you, these partnerships with strategic and financial investors that we believe give us benefits, both, from an operational, from a market perspective. It is something that makes sense. And growth can come, it doesn't mean that being private, you cannot do deals. Of course, shipping offers the opportunity to do one or two vessel transactions, but it also gives you the opportunity to do corporate deals. Like, for example, last year, the acquisition of the fleet of Atlantic Navigation was a Singapore-listed company. It was a 24-vessel transaction, so it doesn't mean that you shy away from bigger transactions.
I want to go down the line here, start with you, Constantine. What would you say are the one or two biggest downsides of size, right? Is there a negative element to it? I mean, do you look at deals differently and maybe not as efficiently as you should? Are you growing just for growth's sake? I mean, maybe give the audience some color as to, what sort of internal things you all think about as it relates to your size and the risks that may pose.
Quickly, I mean, as you grow, you have growing pains, right? So you need to put the systems in place, the processes in place, where you can maintain the attention to detail that's important to have in this business. So that's one thing. Then another thing that you might, a negative theoretically for a larger entity is that you might lose kind of the entrepreneurial spirit or the quick decision making, which again is very important in our business, right? We saw what happened the past few days. You need to be able to pivot and change and decide quickly. So we're very focused on maintaining these characteristics, even as a large organization. But then looking at on the other side, I mean, we see the benefits for us have been tremendous of being a large listed entity. And we've been able to grow, as I mentioned before, but we've been able to play offense in different ways, right? Because, for example, given the size that we were, we saw that in Q2, we had a big discount to where our net asset value was and where our share price was. So we went out, we sold vessels, and we bought 3.2 million shares for more than $50 million. If you have a 20-vessel fleet, you sell 10 vessels, then you lose your economies of scale. You need to really rejig the organization. Being 150 vessels, you sell 10 vessels, you go to 140, you still have economies of scale. You still have the access to capital that's very important that Evangelos has mentioned. So you don't lose anything and you can create value, crystallize value for shareholders in different ways.
Evangelos, I mean, having been with the company as long as you have and seen the growth, what are some of the negatives that you see on the size, or just things that you have to be careful about?
Well, I think I opened with that, saying that growing for the sake of growing is not a solid strategy. I mean, whenever in a boardroom someone says we should pursue this investment because it is strategic, you're probably not going to make any money on it. So you need to have discipline, regardless of size. And size gives you better and more access to capital, but in itself, operationally, doesn't mean you'll get more than the market. Whether you have 100 ships or 200 ships, operationally, your top line, your EBITDA margins will be determined by how efficient you are in running ships. And yes, scale may, for example, bring about cost efficiencies. But other than that, you need to follow very basic principles. Whenever you buy high and you assume excessive residual risk, the chances that your investment is going to go sour, increase. So, and it's very difficult because today you have a situation, especially with us, we have $1 billion on the balance sheet that needs to be deployed, and good opportunities are not readily available. So, we are right now going through the process of trying to identify good investments that are accretive.
I think we have time for one more kind of quick question for the panel, and I'd be remiss if I didn't ask. I mean, we've got four panelists here who, seem to, are largely representative of larger ship owners, but here in Greece, we're in the heart of the entrepreneurial shipping industry. So I'd be remiss if I didn't ask, and I'll start with Hugh. What advice do we have for the smaller, more bootstrapping type ship owner? How do we grow, and how do we access the kind of capital necessary to be competitive in this industry?
Well, it's a good question. I think we've seen and I'll be brief, but I think we've seen a renewed sense of discipline from across the industry, both large and small, which I think helps instill that worldwide credibility in the operators. So, as we've demonstrated stability, balance sheet discipline, growth discipline over the last 5-7 years, you're seeing a wider aperture for the investors, right? And so that's a better opportunity to find larger investors or smaller if you're a smaller growth-oriented name. So I think opening up wider capital sources by virtue of being a disciplined, well-capitalized operator is part of that benefit.
Alexis, I'm going to give you the final word. Any words of advice for sort of the smaller ship owners out there on ways they can effectively grow the fleet? Given the experience you've got on the larger diversified fleet.
Well, diversification is difficult to pursue if you are a small company. Clearly, I think my advice would be to be nimble and. Not to be carried away, I think, by the current state of the market. I think that we are at a cyclical high that is supported by the geopolitical events. So one needs to be, careful in terms of new investments. As far as the smaller companies are concerned, and I think it applies to the larger ones as well, I think one should try to deploy tools that facilitate the management of the fleet. Also consider outsourcing some operational parts of the business. For example, DAs. There is this the Harbor Lab application or ProcureShip, for the procurement of spares. So one needs to follow and use the tools, and that sort of then puts smaller companies on an equal footing with the larger ones, if you see what I mean.
All right, I think we're out of time. So I'd very much like to thank the panel and appreciate the audience's interest and attention. Thank you.